Now, before you even start browsing listings, it's really important you get pre-approved. Setting yourself up early is going to be the key for success here. So in today's video, I'm going to be chatting with mortgage broker and personal friend, Ahmad El-Farram with Capital 360 Mortgages.
Thank you so much for having me. It's always a pleasure. And I love how you said my name, Ahmed.
Did I
Yes,
said it
so
right?
good.
Remember, because we had that old conversation one day about how I should pronounce it
I love it.
when you
I love
had
it.
their show. All right, so in today's video, we're going to break down the entire mortgage process, all the way from that very first phone call to getting you pre-approved. So we're also going to share the most common mistakes that buyers make that could absolutely derail your home buying process. Before we jump in, my name is Clement with eXp Realty. If this is your first time to my channel, please go and click that subscribe button to make sure you don't miss any information on what's happening here in Dufferin County and the surrounding areas. Whether it's 12 days or 12 months out, please make sure to give me a call, shoot me a text, or send me an email. You can find all of my information in the description below. Thank you again, Ahmed, so much for joining me today. I'm super excited to get all of your wealth of knowledge out into the universe for everybody. Ahmed, tell us a little bit about you and we'll dive right in.
That's awesome. Well, I really appreciate the opportunity, Jacqueline, and it's always a pleasure talking with you. So, my name is Ahmed El-Farram. I'm a mortgage agent with Capital 360 Mortgage. I'm located in Newmarket. Our head office is located in Vaughan and kind of service all of Ontario. I love this business. I love the opportunity of being able to help people, whether they're first time buyers, whether they've been through the process, because both of us know whether you've been through the process before or whether you're doing it for the first time today, it's very different. And it is very different than how you've been pre-qualified in the purchasing process from years ago to today. So it's an ever-changing thing. And my job is to try to, as you do the same, try to make the experience as easy as possible.
I love it. So today, the whole purpose of this video is to walk someone through that super intimidating first reach out, that phone call. So I know from my side, one of the biggest mistakes that we as realtors find that people make is reaching out to us first, and not a mortgage broker and not early enough. So why don't we start there? What would you recommend to people as far as when they should be reaching out to you?
Yeah, I mean, okay, so the big topic right now, if we talk about purchasing and timing, is going to be, everyone's situation is different. So what I suggest is get that conversation started as early as possible. If your goal is in, let's say, the next year, the next 12 months, I would say get that conversation going because what I find is a lot of people are closer to their home ownership goal than they actually think that they are. Okay.
Yes, we've had a few conversations where people thought it was never going to happen.
Yeah, and because I always kind of paint it this way. Home ownership is like a target or it's a destination, but the client doesn't know the route to get there, or they don't even know where the target is because they don't understand their own financials through the eyes of the lender who happen to be the gatekeepers to the money.
Right. They seem to all think it just comes down to saving that down payment. And why call you as a mortgage broker versus going to the bank?
Great question. Comes up a lot. And really, the only way I can put it is this way. When you work with a mortgage agent or broker like myself, whether it's me or it's somebody else, you want to be able to think outside the box a little bit. And mortgage lending in today's environment and for the foreseeable future is going to be challenging. And it is very different and is constantly changing. Working with a mortgage broker or agent they're going to introduce you to possible strategies that you won't be introduced to at the bank branch level. Because when you meet with a branch representative that's responsible for mortgages, they have a menu of items that only their branch and only their bank can offer you. Now, not to say that that's not the right product for you, right? So I can't paint a negative picture on the bank because I have to work with them, right? I mean,
No,
I'm
I usually describe it like you can go to a boutique store. I'm a girl, I love to shop. You can go to a boutique store, or you can go somewhere like Winners and Marshalls and get the same thing, but there's more options.
Right. Plus, but let's add on that. So let's build on that is that not only is it that, but you're also going to have a concierge that's going to help you shop. It's going to hold the items for you and it's going to
A personal
suggest, hey,
shopper.
yeah, right. So I'm going to be suggesting, hey, I think that handkerchief is going to match that tie or that shirt. So that's the approach that we have is that kind of concierge service, so that when we do a mortgage pre-approval, if we're talking about a buyer, we're not just saying, hey, here's what you're approved for. Here's a letter, go shopping. Because 90% of the time, number one, people aren't ready at the time that they come to me for whatever reason. My job is to get them ready. And sometimes that requires time and effort. One particular case, it took us a year and a half to get our clients who never thought they could purchase the ability to actually purchase something, and they did. They were first-time home buyers. So sometimes it takes time. And if you walk into a bank branch, they're not going to coach you and guide you and entertain these other strategies and check up on you on a monthly basis. They're too busy doing other things. Right.
In the fact that if you get turned down by your bank, for example, that doesn't necessarily mean there isn't another lender out there willing to work with you. You just have to find them. And that's where your expertise would come in. So take me from the top. Somebody reaches out to you for the first time. Hey, I'm a first-time buyer thinking about making a move in, 6 to 12 months. Where do we go from here?
Awesome. Yeah, you know what? We've got that initial, what we call a discovery call. I like the discovery call because I'm trying to unearth and learn more about what their goals are, and really just be an ear for the first 5 or 10 minutes of, let's say, a 20 or 30-minute phone call.
Well, it's less intimidating too. Discovery call.
People like to talk, right? Look at us. We love talking. So it's like, people love to talk.
I don't know.
And I love to listen. Right? People will tell you if you ask the right questions, they will tell you everything you need to know. And that's kind of my approach with my mortgage business is just talk to me. What are your goals? What do you want to achieve? And then once we get through that portion, after I kind of introduce myself as well, it's 100% transparent in regards to what I can and cannot do. We start digging into the bigger questions. I kind of break it down into sections. We talk about a credit section. So, if you were the client, Jacqueline, tell me a little bit about your credit right now. Do you know where your credit is sitting? And that usually opens up a lot of questions. If I've built enough trust, they're going to open up and talk to me a little bit about whether they've got challenges or not.
I do find in the beginning, often with first-time buyers, there's a bit of a roadblock there because there is so much lack of trust. And just the fact that a lot of people don't even know what their credit score is, let alone how it affects them and how to work with it, make it better, etc.
Yeah. And here's like a funny little, I guess, fun fact is most people that don't know what their credit score is, it's fantastic. It's just, it happens to be that way. Yeah, people with great credit, don't worry about it. Yeah, well, they're not focusing on that number because all they're doing is focus on paying their bills on time and, not overutilizing and things like that. So it's just something that, a little observation that I made over the last couple of years is usually if they don't know, it's usually pretty good. Once we get into the credit, that introduces us to potential problems. And the overall goal of this discovery call is to very quickly figure out, like one of my mentors said, quick to know. Right. So it's either a quick to know, I don't think this is going to happen right now, but here's how we can get it to happen. Or quick to know as in, yeah, this is like, I'm going to know that we've got an opportunity here. I'm looking for credit issues, pitfalls that we need to mitigate. Usually if there's something big, it has to do with the credit. And then we address that and we put a plan together to solve it.
So is there anything else that you need to discuss with them or uncover before you start really digging in?
It's an interesting question because I asked them, are you co-signed on anything for anybody else in your family? Because you know what, as family does, family help each other, right?
Like a car or something, you helped your sister, whatever.
Help a sibling, things like that. And the answer that I get is, sometimes I get a, yeah, of course, but they've been making that payment for the last 4 years. And it's like, okay, but that debt, even though we can prove that you have not paid a single dollar towards the payment, it still falls under your umbrella of credit.
Mhm.
So then we have conversations about, potentially getting you off of whatever you've co-signed, things like that. The other big one in this topic is bankruptcy. And I like to kind of joke a little bit about it, where I tell people, all right, we're going to get a little personal here. So we're kind of, getting into bed together in with these next questions. And that's one of them is, have either of you, if they're a couple coming to me, have either of you been previously married or have kids with anybody else? Right. And that's a heavy question. And I'm assuming that
Yeah.
each of them know their history. But full disclosure for any viewers, anytime we get into the actual nitty gritty of pulling credit and discussing items on that credit report, even if they are a couple, let's say they're married, they've been living together. I am having a one-on-one quick conversation. Hey, just so you know, I pulled the credit. Is there anything here that, your partner might not know about? And I do the same thing on the other side. And it's full discretion because you know what? At the end of the day, there are situations with couples where maybe, someone's got to play catch up a little bit.
Mhm.
And I let them know. I said, look, this is eventually going to come up. I said, but we have some time. And I'm just, obviously giving them the common courtesy to say, listen, is there anything that they don't know about? And from time to time, it comes up. That's kind of that concierge service as well, where, even though you are to get, a couple comes to me, I'm not automatically assuming that they each know each other's dirty laundry.
And just real quick before we jump to the next point, when you're talking about co-signing, you quickly mentioned that you may want to help them explore getting off of something like a co-sign. So you help them through that. As a broker, again, that's something that the bank isn't necessarily, from my experience, going to do for a client, but a broker will hold their hand and walk them through the processes to get them to that finish line. Would that
Yeah,
be right?
for sure, for sure. And I'm not going to age both of us, but we come from a generation where finance and money was never really discussed in school. So
No.
I didn't learn how to properly use a credit card until, a collections agency called me when I was 19 years old. That's just the way that it is. It's like if you don't
Yeah.
have someone guiding you. So I find that a lot of this process is education. And that's why I wanted to start with that point, that a lot of people are closer than they actually think. Student debt, we see student debt as high as $40,000, $50,000. And as an individual, that's a lot of weight to carry on your shoulders. But when my clients realize that, hey, just so you know, that student debt is not looked at the same way as that unsecured credit card or line of credit. The balance may be high, but your minimum required payment is low, and they don't know that. Right. So if you've got a minimum required payment of 1%, maybe the payment's $300-$400. Right. And then
Wow.
you've got a credit card that's got a 30% repayment rate as a minimum down payment. They're completely different things. So a lot of people disqualify themselves because of that student debt. Absolutely do not disqualify yourself on that, because
So
it's
they focus more on the monthly payment than the overall balance.
absolutely, it is based on when we are debt servicing or qualifying a buyer based on how much income they make in a household versus how much debt they have. It's not the total amount of debt, it's the mandatory minimum payment every month on that debt.
That's a really good point. I'm glad you brought that up. So at this point, I guess you'd have a pretty clear understanding of where this buyer stands financially. So assuming that this isn't a quick to know, as you mentioned, and you're ready to sort of continue digging and move forward, what would be next?
Next, we kind of jump into an employment section. And it's learning a little bit about what they do, how long they've been doing it, how they get paid. And we do this for everybody that is going to be on the application, whether they're going to be the actual buyers, if there is a co-signer, potentially a parent, or direct relative, we're also having those conversations with them. If we know that we're going to need a co-signer, I want that that individual,
On the
include
call.
in the conversation as quickly as possible. I'm asking for that introduction. I am taking their, let's say it's a parent. I'm getting the parent's phone number and email directly from the buyers, and I am reaching out as quickly as possible, get a one-on-one conversation going or another group call with everyone that's going to be involved, because co-signing on a purchase is a big deal. It's not something that they can take lightly, because they have tax implications that they have to mitigate. And I understand that. And my job, and in the best interest of everybody, is to get them on board. And it's not about convincing, but it's about addressing the concerns that they have, and then building an exit strategy, right? And that's what, again, that's not necessarily what you're going to get if you were to walk into a bank branch.
So what you're just saying is it's better to bring them in as early as possible so you don't have to play catch up with them later.
Absolutely.
Love it. Okay, so as far as employment goes, what are you looking at?
Okay, so we're looking at where they work. What's the official, what do they do? What's the official, I love the official titles, right? So people
Yes.
tell you what they do, and then you get the official, and the official title is always sexier than what they actually
They're
do.
so fancy.
Right?
Yes.
So fancy.
Yeah.
So I get the official title. We talk about the length of the employment. We're also looking at what are their guaranteed hours, right? So the most common answer I get in regards to how many hours, they say I work full time. Well, full time is very different from one employer to another. We could go anywhere from 44 hours to, let's say, 37 hours or 37 and a half hours. When you take that and you multiply it by 12 months, or how many weeks in the year, that's a lot of money. That's a big gap. And
Yeah.
that can actually make or break a qualification. So, finding out what are their guaranteed hours.
Unless they're on a base salary, then that would be moot,
Correct.
right?
Correct.
Okay.
They're on a base salary. And then the big question that I'm having right now with all the applications that have been coming in is, okay, Jacqueline, based on your T4 for the previous year, what did you make? I get that number. The first thing I do is divide it by how many hours they've worked. The salaried income, there are a lot of additional sources of income sometimes, depending on your employer. So we have, allowances, which can be taken into consideration. We have, whether it's a car allowance, things like that, vacation pay, sick days. We also have bonuses, but generally speaking, we are looking for a 2-year history on a salaried employee. Okay. But there are exceptions to that. Two of those exceptions that we see regularly: anyone in education, anyone in law enforcement. I love working with people in those fields because, and lenders love, and they love to have clients that are in those professions, because number one,
Government employees.
yeah, there's guaranteed income. The
Yeah.
salary is guaranteed. Not only is it guaranteed, it's guaranteed to go up every single year, which is a great thing. So you've got somebody that generally is in the first, let's say, 5 years of a career path that is on a trajectory upwards. How fast it is, it doesn't matter. But there's security there from a lender perspective. And the big discussion right now is mortgage fraud. When you're dealing with someone in law enforcement or in the government or in education, there's no opportunity for fraud there.
Now, what about self-employed?
Self-employed. This is where reaching out early is going to be in your best interest.
So that you can make sure, because obviously a lot of us try to put a little less on our T4s if we're self-employed, but make sure that they are as up to snuff as they could be if you're planning on trying to get a mortgage.
Everyone, whether you're sole proprietor, you're incorporated, everyone's at different stage in their business. And you brought up a good point. I work with a lot of realtors and commission-based individuals. And you know what? It's in your full right to take advantage of opportunities as a self-employed individual to pay less tax, right? That's one of the reasons why we become self-employed. And there's nothing wrong with that. But at the end of the day, you could potentially, let's say, end up making in the previous year, let's say $250,000. But at the end of the day, you're paying yourself and claiming personal income of, let's say, $60,000. because of all the expenses of running a business. And that's
Yeah.
perfectly fine as long as it's within the range of what's acceptable. When it comes to qualifying, this is how I paint the picture. I said, either way, you have to pay the piper. You have to pay somebody. So when it comes to a self-employed mortgage, we can go what's called a stated income route. So instead of your traditional T4s, we're looking at a 12-month history of the business and the health of the business via 12 months bank statements. That's
Okay.
great. So we're looking at the health of the business, and we've taken out what your corporation or what your business pays yourself.
That's a significant difference.
So the qualifying based on a 12 months bank statements, the strength of that business, and pulling out only what the regular operating expenses would be. Let's say desk fees, let's say insurance, let's say broker fees, whatever those regular payments are in that business. That's what we're deducting from that total income, and then we're left with a number that is significantly higher than what is the taxable income on a personal level. And what's the cost of doing business? The cost is usually a 1 to a 1.5% fee.
What do you mean? What is this fee?
So, perfect example. Let's say you walk into a bank today and you qualify the traditional way, you end up getting, let's say, an interest rate of 4%. You're getting that mortgage, the same mortgage, at a rate of, let's say, 5% instead. So
Okay.
it's 1% higher. Okay.
Because there's higher risk for the lender,
Because
obviously.
there's higher risk for the lender. But now we're potentially qualifying. And on the last application that I did, I was qualifying the income at $100,000 more than the taxable income. But we are an access to self-employed individuals. It's a lot easier working with a mortgage agent or broker, especially if you're self-employed. So sometimes qualifying as a self-employed individual means you need to get another tax year under your belt. And we're
Okay.
there to help you. A lot of times people are paying themselves, self-employed individuals are paying themselves too much because
Yeah.
their accountant told them, hey, if you want to qualify, you better pay yourself more. And honestly, that's not the route to go, because at the end of the day, is 1% paying a 1% fee or 1% higher on that mortgage, where are you saving more money? Paying that 1% fee, or increasing your taxable income at a tax rate of 40 or 50%? These are the conversations that I'm having with the clients, right? So what are the pain points? I'm looking at the whole picture, and we're moving the needle. My team and I are moving the needle on buyers simply because we explain the process in a way that they understand, and we're introducing ideas to them that they didn't know they had.
Right. And I just want to be clear, we're not talking tax fraud. We're just talking working with an accountant, your bookkeeper, and a broker to shift things around, but legally.
Yeah, look, and at the
Like
end of the
it's
day,
just a placement factor.
absolutely, we have credit unions, we have access to banks that really they value self-employed individuals. So you could walk into your bank and they don't even have a stated income mortgage product because they're not interested in working with self-employed individuals.
When do you educate them about their down payment and how much they need and how that works?
Yeah, so based on, once we're done with the employment and the income conversations, we jump into down payment at this point. We're talking about their goals based on, are they, first of all, are they realistic goals, right? If they say, Ahmed, I want to purchase a house in Newmarket for $450,000, it's not really realistic. So
Right.
once we figure out what their realistic goals are, then I break down the numbers for them and present it based on the income that they currently have and how the bank is going to see that. And then we see if they align, right? And if they don't align, what do we have to do to align them and create a strategy to get them where they want to be? And a lot of the times that's getting a cosigner. A lot of the times it's not necessarily more down payment. A lot of the times it's just paying off certain things, right? So, car payments are deal killers. But again, going back to the conversation about it not being the balance owing, it's the monthly payment. Pay the car off And then now your purchasing power just increased by $150,000.
Yeah, we
That's
talked about that the other day, and I found that mind-boggling.
yeah. So now
Amazing.
we're talking about down payment. We're talking about all the additional costs, lawyer fees, moving costs. If we have to do any kind of preparation for tax, HST if it's applicable. So I'm creating several different budgets for a potential purchase scenarios. And what we're also doing is breaking that down into different mortgage products, whether it's variable, fixed, different terms. And I'm a very visual person. So when I send over pre-qualifications, I'm doing them in a video form where I'm walking them through the different scenarios. And it gives my client the ability to rewatch it. I'm a visual person. That's how I like to communicate. And I don't like to be put on the spot. So I'm not going to walk someone through a qualification over the phone and have them jot down the numbers, because I know how I am when I do that. I'm always making mistakes. I'm always jotting down the wrong numbers. So having a video that's like, let's say anywhere from 5 to 10 minutes long, they can watch it. They can see me in the corner and I'm walking through the documentation, showing them the different breakdowns, and they can look at it, absorb it, and go back to it so that when it comes time to make a decision, they're making an educated decision and a confident one.
Awesome. So, okay, because we're gearing this towards first-time home buyers, maybe they're coming to us in this video at a point where they're not sure how much of a down payment they would need. So obviously that depends on the price of the property that you'd be looking to buy, but what are the percentages? How are there still first-time home buyer incentives? Because there's been a lot of change to both of our industries in the last year. Can you talk to us a little bit about that?
Yeah, absolutely. We've seen a lot of changes federally. I think they're all pretty good if they're used appropriately and they're used as a tool to help you get into the market as a first-time home buyer. And the number one tool that I'm going to share with you is obviously the rule in regards to first-time home buyers can stretch the amortization to 30 years if they have an insured mortgage, meaning they don't have 20% down.
Can
Right?
you give a quick explanation of what amortization means?
Sure. So when you qualify for a mortgage and you choose a mortgage product, amortization is the life of the mortgage. So you have the amortization, let's say a 25-year mortgage or a 30-year mortgage or a 35-year mortgage. Now we even go to 40. So you have the amortization, which is the full length it will take you to pay off the property.
Not to be confused with term.
Yeah, not to be. And then within that, you have terms. And the term means you're negotiating a small set period of time within the entire mortgage. Usually 5 year was the most popular. A
Yeah.
5 year term, you're negotiating to say, in these 5 years, I'm going to pay this. And here are the rules in regards to prepayment and penalties. Every time a term comes up for renewal, you renegotiate. And a mortgage agent or broker like myself can do that on your behalf to set the next term. So the idea is that, let's say you stick with a 5 year term and you have a 30-year mortgage. It's going to take you 6 terms to own the property outright. If you are only paying the minimum, not taking advantage of prepayment, not working any other strategies to shorten the life of your mortgage. That's the
Well,
difference.
that's a whole nother video. We'll have to do
Yeah.
another one based
Yeah.
on the refinancing, but
Yeah, going from a 25-year term to a 30-year term is going to lower your monthly payment, but it also means that more money is going towards interest than principal. And working with a mortgage agent, this isn't something that we can just jump into in a video because it's a very, very detailed conversation. But stretching out from a 25 to a 30 increases your purchasing power because it lowers your monthly payment. So that is something that's available right now to first-time home buyers, which is the best, I think, the best tool that is a great starting point. Now, the longer the amortization, the longer it's going to take for you to pay off that property. Is that a bad thing? No, because it's a tool that we can use temporarily for the first term to get you into the property. And we do that. And there's an exit strategy to shorten the life of that 30-year mortgage by taking advantage of prepayment privileges and things like that.
okay, so really briefly, you sort of mentioned that they could put anywhere between 5 to 20% down. Can you explain why someone would put 5 versus 20 and when that sort of applies?
Yeah, and you know what? You can even go if it's available to you. You can even go with more than 20% down. But the difference between, let's say,
Does that happen?
yeah, you know what? It happens when you have somebody selling a property and purchasing a new one. Like potentially, let's say somebody that's downsizing and they're selling a property that has no mortgage, or maybe it's got a small mortgage on it because they've owned it for a long time and they've been, actively paying down that mortgage, right?
Okay, makes
So,
sense.
um,
I don't have that kind of money, so that would be nice.
okay, so when we qualify somebody to purchase a property, we're looking at the amount of income versus the amount of debt, including the debt of the actual mortgage. Think of it this way: the less the down payment, the more income you need to make, right? So if you're going to take advantage of the absolute lowest minimum down payment that's available, which is 5% for the first 500,000, and then it's 10% for anything above that 500,000 to the purchase price. Okay.
I gotta love all the tiered things that happen in mortgage and real estate.
Everything
It's
is
great.
tiered. Everything is tiered.
Never black and white.
Life is turning into a two-tier system. I'm not going to be
It
negative. So,
Okay, so assuming they're putting 5%.
yes. So basically, the lower the down payment, the more household income we need. Okay. So it's think of it like a teeter totter. Like it's different for everybody. And that's the reason why we get into the conversations about income is because based on a purchase price, if they make a certain amount of income, they need to have a minimum down payment. And we figure out what that number is. And then
Okay.
we assess, okay, how do we get you there? For a lot of people, the income is not the problem. It's the down payment that's the problem because as home prices go up, the
Hmm.
minimum down payment gets increased,
Yeah.
right? So no matter who you are and what situation that you're in, there is a solution for everybody. It's just trying to figure out what that solution is. And a lot of people just need someone guiding them and giving them that target, like I had mentioned. So if the target is, we need 15 extra $1,000 in order to reach that minimum down payment because your income is good and the house price that you want is good. So how are we going to get you there? How can we achieve that goal? Is it getting a gifted down payment from a relative or family? And if that's a possibility, then we're bringing in the parents in the conversation, or whoever is gifting the money. Or maybe it's, hey, you know what? I get a bonus at the end of the year. Maybe that's the bonus that's going to help us do it. But the one thing you cannot do, I never recommend if we're looking to get more down payment, taking it from a line of credit or a loan. So,
Right. Well,
because
that's just working backwards, really.
it can be working backwards, and most of the time it is. So that's just something to keep in mind. But whatever that situation is, the lower the down payment, the higher the income that is going to be required.
If they're putting anything less than the 20% down, they need mortgage insurance. Is that correct?
Yeah, that's correct. Great point. So, what's called mortgage default insurance. So, in order to mitigate the risk of the lender, because you're not bringing to the table at least 20%. And let's be real. Like if we're talking about an average household in our area for let's say $1 million, and you're coming to the table with the minimum down payment, the bank is putting more of that money on the line than you are.
They're sweating a little bit.
Yeah, like they're really taking that risk. And I think when I kind of paint the picture that way, in a joking way and kind of being sensitive as well, it's they understand like this is why you have to jump through a lot of hoops. This is why there are rules. Home prices have increased dramatically, and that's a big challenge. That's the number one roadblock that is if you're a first time home buyer that we have to overcome. I purchased my
Coming
house.
up with the down payment.
The down payment is much higher because the home prices have increased so much.
Right.
Right. So that's
So I just wanted to mention too that the mortgage insurance is most commonly referred to as CMHC insurance, which is the Canadian Mortgage and Housing Corporation. So just language wise, as we're talking, it can be referred to as both things, mortgage insurance or CMHC insurance.
Now, there's a premium, just like any insurance. If you were to get life insurance or home insurance or whatever, life insurance, like and home insurance, you're paying a premium every single month, right? So whatever that is. Now, with the mortgage default insurance or CMHC insurance, that premium gets added to the mortgage balance. Okay, and it's upwards of 4% of the purchase price. That's huge, right?
Mhm.
So if you're talking about an $800,000 mortgage, you're talking about an insurance premium of upwards of 4%. To put that into perspective, let's say you start your mortgage from day one, your balance on your mortgage actually increases by the entire amount of that premium of that 4%. Like you never get that money back, right? So
Yeah.
this is why at the end of the day, it's a tool that helps people get in. And, you know, for a lot of people, reaching that 20% mark to avoid the insurance premium is not a reality. To say you're not going to get it back, you will earn if you hold on to the property long enough. You will earn
Well,
equity.
at the end of the day, that's why we're all buying real estate anyways, right? It's
Absolutely.
buy real estate and wait. Don't wait to buy real estate.
Exactly. So that's the mortgage default insurance in a nutshell.
Okay, and we will put a link in the description below to some more information about the CMHC mortgage insurance. Now, we also touched a little bit, you threw out a few different things that come up, and we refer to them generally as closing costs. Seems a little early to be talking about things like land transfer tax and lawyer fees, but there are requirements that come from this stage in the process that basically ensure that they have enough money in their down payment to cover these closing costs for when they actually hit that finish line, right?
Yeah. So, one of those closing costs is land transfer tax, which is the biggest one. So hopefully we're going to see some federal changes in regards to that being, removed for first-time home buyers, which would be really nice because, just purchasing the home alone comes with a huge tax. So,
It is the biggest, and another one of those annoying tiered calculations. So unfortunately, we can't give you like a cut and dry calculation of what it would be. I'll also link a land transfer tax calculator below, but it is the biggest expense of the closing costs for
for sure.
sure.
So now, on paper, in regards to the rules that we have to follow by qualifying individuals, we need to, in addition to whatever that down payment is going to be, completely separate from that down payment, whatever account that's in, we also need to show that the buyer has 1.5% of the
Minimum.
purchase price set aside for closing costs. But the kicker is that whatever that number works out to be, the 1.5%, whatever that number works out to be, that doesn't necessarily mean that's enough to cover the closing costs because we know, in the GTA, if you're purchasing in Toronto, you have a double land transfer tax, right? And
Yeah.
depending on the purchase price of the home, you've got a different land transfer tax. Depending on different region that it's in, you've got a different, it's all
It really is only the poor people that live within quote unquote Toronto proper. They pay double. They pay the provincial and a municipal,
right,
whereas anywhere else in Ontario, you only pay the provincial.
which is
So good point
and
to keep in mind if you're buying within the GTA. That is double huge.
the land transfer tax, as a first-time home buyer, there is a rebate available to you, and it's upwards of $4,000 per buyer, right? So per person that's on that
But
title.
in most cases, for the budget of what a first-time home buyer can afford, that would be almost half of the actual land transfer tax, roughly in some cases, maybe even a little bit more than half.
Yeah,
But again, it all depends on the ending purchase price of the property because it's a tiered calculation. Check
absolutely.
the link below.
Yeah. Now,
Um,
if I guess to add to that, if somebody, let's say you've got a blended family, or you have a couple where one of the buyers on the new purchase has previously owned or still owns a property, when it comes to the land transfer tax rebate, because 50% of the buyer of the ownership is not considered a first-time home buyer, they only get half of the land transfer tax rebate.
So once we've gone through all of that, and again, closing costs are huge. I think we should probably just cover sort of other things that come up with closing costs because it's a very vague term. So this is another reason why we haven't even touched on this yet in our conversation, actually, Ahmed, is the relationship between your realtor and your broker or your lender is crucial. We really do recommend trying to connect those parties as early on in the process as you can. Once you know for sure who you want to work with on both fronts. And these closing costs are something that we can communicate about on the back end so that I can make sure that you're educating them on the financial front about these closing costs coming up. So closing costs are going to be things like their lawyer fees. Again, every lawyer is different. Every transaction is different because usually they're based off an hourly basis. So if you are purchasing a property and there ends up being hiccups or anything like that upon closing, issues with title, that fee can be a little bit higher. But lawyer fees, the land transfer tax, as we talked about, moving costs. I don't know why, but people generally tend to forget to calculate that in a moving truck, right? All of those things associated, missing work for a couple of days in order to get your move done. So those are all part of what we call closing costs. You're also going to have potentially a property tax adjustment. If you've ever heard the term proration, your lawyer at the end of this, right before you close, they're going to prorate the property taxes. And if the seller's overpaid, then you have to pay them back. So these are all why the government, as Ahmed mentioned, is they make sure you have at least 1.5%. We do generally recommend 2 to 5% extra on top of your down payment. And hey, if you end up with extra left over, you don't spend it all on the closing costs, then great. You now have a little safety egg, which is another thing that we recommend that you have, because home ownership is not like renting. When something goes wrong, it's all on you, and something always goes wrong. It's home ownership. There's always something breaking, and there's always something that needs updating or fixing. So that's just some info on closing costs. Now, next would be talking about current properties. You touched on that really quickly.
Yeah, so definitely during that discovery call, I really dig deep into current properties that they own. So part of the process when you qualify for a new purchase, if you own properties, we are going to have to take a look at value of that property, what the mortgage, existing mortgage balance is on that property. We're checking to make sure that the property taxes have been paid and are up to date on those properties. So I'm glad that you brought this up because I think there's a bit of a misconception because, if you're coming to the table with assets, all those assets generally have to be disclosed to the new lender as we're qualifying you for a purchase. So it means additional documentation. It means additional due diligence.
Do you find that they always just assume the financing end is going to be fine?
Absolutely, yeah. And you know what? A lot of the times it is, a lot of times it isn't. And because it's not necessarily just the property itself, it could have a low mortgage. But if there are things on title there, like if we have lines of credit, if we have other things on there that are associated with another property, those things all got to be kind of taken into consideration. At the end of the day, whether it's your first time buying or you've purchased before in the past, it is not an enjoyable process. It's really not. It's like going to the doctor
I
for.
find it fun.
I mean, we find
My
it
side
fun,
is fun.
but because I like to be realistic. I am going to be there to take, let's say, a less enjoyable process to ensure that we cross the finish line. And I'm gonna be there as the light, kind of signaling potential concerns that we need to address, and we address them in advance. But is there less stress buying today if you had purchased already 5-10 years ago? Absolutely not. There's more stress. And when it's painted in a way that we're here to guide and help through a process to not make it more stressful like some of the individuals that we've had to engage with in the past. And I'm not talking about clients, I'm talking about other real estate agents, lawyers, things like that. People do business the way that they do business. Our goal is always, from day one, both of us have always been focused on client experience.
Mm-hmm.
That's it. If we
And I get to your point, that doesn't mean that we don't discuss the uncomfortable, the good, the bad, the ugly, and everywhere in between. But it's when we discuss it and set those expectations, because that is the most important thing in both of our jobs, is setting a client's expectations of what's to come. And if you make it all sunshine and rainbows and it's not, well, who looks bad at the end of the day, right?
yeah,
Regardless of personal circumstances,
yeah.
that all falls on us to help guide them, because that's our job.
And the expectations, they work both ways. So it's a two-way street. So
Yeah.
here's what you can expect from us. Here's what we expect from you.
Yes, thank you for mentioning that, because that is key. It does go both ways.
Absolutely.
So now let's talk about the new property. We've almost got them to the finish line to be pre-qualified. Next is talking about the property they want to purchase.
Yeah.
What is the bank looking for?
So once we align the goals with the mortgage pre-qualification, what we're doing is I am doing, let's say, a conditional pre-qualification. And that's really the technical term, because so much of the bank's pre-approval on the individual buyer is based on the home or the property that they're going to purchase, right? So
Right. So everything we've talked to up until this point is working towards a pre-qualification.
yes.
And I'll just note to everybody right now, before you call us a real estate agent, one of the first questions we are going to ask you is if you're pre-approved. Very different things in the eye of the real estate agent. Sorry, I just had to make that note.
Yeah, so let's talk about a pre-approval, because and again, let's use the language that everybody uses. Do you have a pre-approval? Yes. Now, that pre-approval is based only on the lender seeing the buyer's credit report. That's it. They haven't looked at bank statements. They haven't looked at T4s. They haven't looked at NOAs. They have not looked at a job letter. They know nothing about their employment. So that's why it's called a pre-approval. It's called a conditional pre-approval. That's the technical term, because it's conditional on the lender.
Pre. Everyone forgets that it says pre.
Yeah.
Approval.
It's not an approval.
Right.
Not an approval. And it's not saying that to scare you, but what it is saying is, just keep in mind that depending on the property, if it's a condo and there's litigation against the condo board or the building itself, you're not going to get funding on that, right? You will not, even though you've got a pre-approval, they have to be okay with that property. And if they're not okay with the property, you're not going to get the financing for it.
So just to be clear, you could go through the entire pre-approval process, submit an offer, get an accepted offer, put it into that lender, and they could still say no.
Yes, absolutely. Absolutely.
Yeah,
And
I've
I
seen
deal
it.
with, yeah, and I mean, I deal with a lot of homes that are like in Georgina area, things like that. You know, you deal with asbestos, you're dealing with homes that have a lot of, structural issues, septic tanks. To change a septic tank is going to cost you $30,000. It used to be something that was like maybe 10. Now the going rate is anywhere from 25 to 30. Right. So these are big things. If they do not like the property for whatever reason, financing can be a challenge.
I'll just take this opportunity to point out this is another reason, and it has become crucial and saved deals and a lot of heartache for buyers of mine, is connecting your realtor and your broker. I'm going to beat that with a stick, because a lot of people don't realize that the specific property has so much weight on the end result, whether they're officially approved or not.
And if we're talking about a minimum down payment purchase scenario, we talked about mortgage default insurance. That CMHC, that mortgage insurer, also has to be okay with the property.
Right.
So not just the bank. Now we're adding an extra potentially 2 business days to give the mortgage insurer the opportunity. This is why at the end of the day, I don't care what market we're in, condition of financing is always important. If it's an insured property and it's in a certain area, I'm recommending at least 5.
Now, it could also simply be if they feel that the price is way inflated compared to what it should be valued at. There is a lot at play. They don't love rural properties either. And another reason why I personally always recommend to work with a broker versus the bank, we didn't even touch on that in the beginning, but Scotiabank, I'm just going to throw them under the bus here in a good way, that they are one of few lenders that don't mind rural properties and farms. They actually kind of use that as one of their specialties and things that they offer versus others. So if you were with TD originally and you were looking to get a mortgage with TD and you want a rural or farm property, you're probably not going to get approved and would need to pivot. So a broker would be able to do all of that for you. And they would know ahead of time who the best lender is to go to for the specific property you're looking for. Did that make sense?
Yeah, absolutely. Absolutely.
Perfect.
I really love that you brought up pairing up the real estate agent and the mortgage agent or broker, because in the end, we're a team, and I'm looking for that introduction. I want to know who their realtor is, because if the realtor is going out and taking buyers out to show properties that are way outside of their price range,
we're setting the entire thing up for failure. Plus,
yes,
you're putting your real estate agent in an awkward, professional, ethical situation. Reputation does actually mean a lot when it comes to negotiations. I have won deals that maybe weren't always the most money, but the listing agent had trust in me that I've done my due diligence and background research on my buyer. Mm-hmm. That when I say my buyer is pre-approved, they know that I've spoken to their lender or mortgage broker. They know that I'm not showing them properties well beyond their means.
Yeah, for sure. So I think the overall goal is that you're going to have a team behind you. Connect that team so they communicate and work together early on to ensure your success. So once you've got an accepted offer with a condition of financing, that's immediately sent over to me, and then I supply that directly to the lender, and then they come back. And then at that point, we get a commitment from them that says, okay, this is a formal commitment. We love the property. Here's what your monthly payments are going to be based on the product that you chose. And here's the agreements. Here's what's expected of you as a homeowner. And then here's what you can expect from us as your lender.
Amazing. And I know firsthand, Ahmed will walk you through, both him and myself, our jobs are not done the minute that your offer is approved. We will continue to walk you through the entire process up to and including closing day. And we touch base with you afterwards, just to make sure everything's on track and as you expected it to be. So Ahmad, how can people get in touch with you if they want to? Again, I'm going to put all this info below, but.
Perfect. All the info, all the links are below. askahmed.ca. You can start there. I'm very active on Instagram. There's a lot of content that I put out on a daily basis. Number one, you got to have a good feeling. Check out the Instagram. If you like what you see, if you like the way that I communicate, it's exactly how I'm communicating right now. If you think we're a good fit, then I want to work with you.
It's a vibe.
That's it. It's the vibe.
It really Awesome. Okay, well, that is it for today's video. We really hope that you guys took some valuable information away. Please feel free, if you do have any questions, to reach out to either of us. All of our contact information is below. And again, if you did get any value from this, make sure you hit the like button and subscribe so you don't miss any future important content. I am also putting another video together that will walk you through the entire home buying process from the real estate side, all the way from getting that pre-approval to actually getting the keys on closing day. So again, click the subscribe button below, and we will see you in the next video.